Good day, ladies and gentlemen. Welcome to today's Fund Focus webinar. In the Fund Focus webinar series, we'll discuss the fund of funds within our PSG multi-management solutions. Today, we are focusing on the PSG Wealth Global Creator Feeder Fund. I trust that you're all familiar with PSG multi-management and what we do. In this Fund Focus, I'll provide a brief introduction to PSG multi-management and then move on to the PSG Wealth Global Creator Feeder Fund. Your dedicated investment specialist will be able to assist you with more information on us or any of our funds. A brief introduction to PSG Multi-Management. What do we do? We solve the challenge of selecting and combining funds. We combine portfolios from a group of distinct but complementary investment managers into a new portfolio known as a fund of funds. Why do we do this? To reduce the level of volatility and risk and potentially increase long-term returns for our clients. Who is this for? It is for PSG Wealth Advisor clients who are seeking a professional multi-manager to manage their fund selection. We have a comprehensive range of solutions that meet varying risk and return needs. How do we achieve our results? We follow our three core principles. We place return, risk, and value for money at the forefront of our selection process. We believe that all three cogs are important, should complement each other, and should not be viewed in isolation. For example, just because a fund is delivering outstanding returns does not mean that it should be included in our fund of funds. We investigate where the returns came from, are the returns sustainable, how much risk the manager takes and the strategy entails, and what the fee structure of the fund is. Overall, we aim to generate above average returns at below average risk and offer value for money. Our aim is to construct a portfolio of funds that is diversified across various investment managers to minimize short-term volatility without compromising on long-term returns. What are the advantages from a client's point of view? They achieve diversification across all asset classes, across investment managers with different investment styles, mandates, and risk profiles. Reduce risk because of this diversification. They have a dedicated asset allocation expert that make underlying fund choices on how to best combine these funds. They have access to a wider investment universe with a single investment. PSG Multi-Management have robust governance and processes in place to reduce overall investment risk, and we monitor our funds on an ongoing basis to ensure optimal returns and reduced risk levels. What are the advantages from an advisor's point of view? You spend less time researching and selecting funds, resulting in more time in front of your clients. This essentially allows you to grow your book more effectively. We increase the scalability of your book as individual asset allocation and fund selection is reduced. Advice risk is reduced and automatic compliance with PSG Wealth financial planning policy and procedures is achieved. It allows for more efficient administration, such as easier switches, the same market price for all clients, and a reduced number of funds in your overall client book. Lastly, you have more flexibility with regards to client-based management. Today, I chose to speak about the PSG Wealth Global Creator Feeder Fund. It is a feeder fund, in other words, a rand-denominated fund that feeds 100% into our global equity fund of fund, the PSG Wealth Global Creator Fund of Fund. So it aims to be fully invested in stocks at all times. Just a quick background on the fund. It was Warren Buffett that said, the most important quality for an investor is temperament, not intellect. One of the primary advantages of offshore investment exposure, such as the exposure gained by investing in the PSG Wealth Global Creator Feeder Fund, is the global diversification achieved by the investor. This type of diversification reduces the risk based on being exposed to a single region or country-specific political and economic risk, currency risk, and therefore it provides a broader exposure to companies and earnings achieved globally. Benjamin Graham famously quipped, "The investor's chief problem, and even his worst enemy, is likely to be himself." Your own emotions actively work against you reaching your investment objectives. This is especially true during times of increased political uncertainty, such as currently experienced by South African investors. One of the common traits that great investors share is their understanding of the instincts, emotions, and tendencies of investment behavior. With regards to global investments, we Well-known South African market commentators have said things like, take everything offshore at any cost in 1994, in the early 2000s, and in 2016 onwards. And they also said things like, the rand will go to 70 rand against the dollar. In short, offshore investments, such as the investment in the Global Creative Feeder Fund, should be part of your portfolio, but for the right reasons, and not based on emotional unpredictability of short-term aspects, such as politics and sentiments on the rand. The PSG Wealth Global Creative Feeder Fund is an excellent choice for PSG Wealth clients to gain offshore exposure. We'll now look at the objective of this fund in more detail. The primary objective of the portfolio, via its holding in the underlying fund, is to maximize returns through active management of a diversified portfolio of equity-based collective investment schemes. It is for investors seeking a global equity portfolio aiming to generate long-term wealth. Investors should be comfortable with market fluctuations, in other words, short-term volatility. The fund is well diversified across sectors and securities to mitigate the effects of short-term volatility. The fund has a minimum recommended investment horizon of 7 years due to its full allocation to equities and the currency exposure inherent in the portfolio for South African investors. The feeder fund is classified in the ASISA ASISA Global Equity General Sector, while the PSG Wealth Global Creative Funder Fund is classified in the GIFS Global Large Cap Blend Equity Sector. It has a maximum net equity exposure of 100% and an average equity exposure of around 95%. As a standalone fund, it is not suitable for use in retirement funds as it is not Reg 28 compliant. However, it can be used in combination with other funds in these products as long as the overall investment complies with Regulation 28. Looking at the underlying managers, the feeder fund is about 4.6 billion in size, invested fully in the PSG Wealth Global Creative Funder Fund. The Global Funder Fund is split equally amongst 9 underlying managers. We make use of various reputable managers with proven track records and that have true global footprints. They are Goldman Sachs, BlackRock, T. Rowe Price, Columbia Threadneedle, Fundsmith, Investec, Veritas via Netgroup Investments, Vulcan, and Schroders. 9 funds may seem like a lot, but our research into the dispersion of fund returns indicates that there is a significantly larger spread in fund returns for global fund sectors compared to domestic fund sectors. This indicates that there is a higher selection risk in global fund sectors. Selection risk in this context refers to the probability of selecting underperforming funds. In our view, the higher selection risk for global fund sectors requires a broader selection of managers to offset the potential of having underperforming funds, specifically in the short term. Given that one of our key objectives is to deliver consistent above-average returns, managing selection risk is a key part of our process. In our research into the optimum number of funds, we consider a number of scenarios centered on determining how many funds are required to offset 2 bottom quartile performing funds. This is to ensure that the portfolio still achieves above average or top quartile performance. Additionally, we also conduct stress tests to determine how many additional funds would be required to still achieve above average return targets, especially if 2 of our underlying funds are the worst performing funds in the entire sector. This research then helps us to determine how many funds there should be in specific fund of funds. According to our research, the optimum number of funds for domestic income funds is between 4 and 6 funds, between 5 and 8 funds for domestic multi-asset low equity and multi-asset high equity funds, and also for general equity funds. Global equity funds should be between 7 and 14. A further advantage of our fund is that it gives investors access to underlying managers that they would not normally have access to because A, the minimum required investment is too high, or B, the funds are not directly available to retail or South African clients. I'm not at liberty to unsolicitedly discuss all of the underlying funds in the PSG Wealth Global Creative Funder Fund, as not all of them are Section 65 approved, but our overall funder fund is importantly Section 65 approved. However, the following table describes the broad investment style and role in the funder fund of all of our underlying managers. Our competitive advantage is our ability to identify managers that have true investment skill, understand the investment style, and combine these different styles in a diversified portfolio which have a high probability of reaching the stated investment objectives. By diversifying across different investment styles and philosophies, our portfolios deliver consistent return profiles, which any single manager on its own would struggle to achieve. For example, the Investec Global Franchise Fund is built from the bottom up with a long-term focus, targeting cash-generating companies able to sustain high returns on invested capital. Stocks typically have low sensitivity to the economic and market cycle. It is a high-conviction stock portfolio of primarily investment-grade companies, which typically have high customer loyalty, strong brands, no debt, and are more resilient in times of economic uncertainty. It therefore follows an active management quality philosophy. While on the other hand, the Schroders QEP Global Strategy aims to deliver consistent outperformance of the MSCI World Index with limited index relative risk. It is designed to offer investors the benefits of index-based investing from a risk and cost perspective with the advantage of relative outperformance. Top-down risks are managed in the portfolio construction process by applying index relative limits to regions, sectors, and stock weightings. This results in a low tracking error, but the team maintains flexibility to invest in a controlled amount in the best opportunities beyond the index. It therefore follows an index relative value philosophy. As mentioned, this fund invests fully in the PSG Wealth Global Creative Fund of Fund, which is a 100% equity, 100% global fund, which is evident when looking at the fund's asset allocation. The average equity exposure in the fund of fund is closer to 95%, with the remaining 5% kept in cash for opportunities and other liquidity needs. The fund of fund has the biggest exposure to the technology sector, which includes companies such as Oracle, Microsoft, Apple, and Alphabet, the holding company of Google. It also has large exposures to the healthcare and financial gig sectors. The smallest sector exposures are to the basic materials such as resources and mining companies, to utilities and communication services companies. Our best of breed investment strategy is focused on manager selection, and we do not try to overlay any specific asset allocation views within our portfolios. This is because we are aware of our own strengths and do not believe that we are best positioned to make the required asset allocation, regional allocation, or security selection calls. We select highly skilled fund managers and allow them to make the required allocation and selection calls because that is what they are good at. When we select managers for our global fund of funds, we specifically look for managers which have a true global mandate and investment style, meaning they look for the best opportunities across the globe and not only in a specific region. We constantly monitor our underlying managers' positioning. The PSG Wealth Global Creative Fund of Fund has a slight overweight to the US of 2.5% relative to the MSCI World Index. The fund of fund is also overweight UK 4.7% and underweight Japan minus 4.8%. The fund of fund also has an overweight allocation to emerging market assets with 2.9% relative to the index's 0.5%. In last quarter's RNS, we noted that underlying managers within the PSG Wealth Global Creative Fund of Fund generally have high concentrated portfolios with significant active share. Additionally, most of our underlying managers use bottom-up fundamental research and aim to deliver most of their alpha through security selection. Given the concentrated active nature of our underlying managers' portfolios, the exposures does differ significantly from the broad market index. We believe all of our managers have the ability to generate alpha through the various strategies they use, and therefore, while the broad US market does seem to be expensive, we trust our managers to use their security selection skills to find good alpha opportunities that remain within this market. The fund's top 10 includes some of the major counters around the globe. It has 10.1% in its top 10 equity holdings, so the fund is not too concentrated in a handful of stocks and provides great diversification across sectors and regions. Moving on to the first pillar of our investment philosophy, performance. We aim to generate above average peer group beating returns. Since the fund was only launched in June 2013, there are limited 4-year rolling periods available and no 5-year periods. This graph illustrates the 3-year rolling excess returns of the fund relative to the CISA peer group average. The dashed line is the average of CSA Global Equity General Fund, so South African domiciled funds, while the blue line is the average global large cap blend equity fund, so funds domiciled across the globe. We prefer rolling returns to growth charts, as rolling returns show consistency of performance and is not so heavily impacted by a start and end date. As you can see from the graph, the fund has outperformed the peer group average by 2% or more over all rolling 3-year periods. This graph illustrates the percentage of 1-year rolling periods that the PSG Wealth Global Creative Fund has outperformed relative to the CSA Global Equity General in the top graph and relative to the GIFS Global Large Cap Blend Equity sector in the bottom graph. The PSG Wealth Global Creative Feeder Fund D has outperformed its South African peers over 80% of the 1-year rolling periods, and its global peers over 90% of the 1-year rolling periods since inception. We judge funds with high equity exposure over much longer holding periods, such as 5 years and above, but the short-term consistency of our funds are testament to how our split funding approach reduces short-term volatility and promotes investor peace of mind. Moving on to the second pillar of our investment philosophy, risk. We aim to deliver our returns at below average risk. For risk, we look at downside deviation, since upside variability is not necessarily a bad thing. The downside deviation provides a better indication of the risk that matters to investors. The fund has achieved lower risk than its average peer in the GIFS Global Large Cap Blend Equity sector over 100% of the 3-year rolling periods since common inception. When considering risk-adjusted returns, one of the risk measures that we look at is the information ratio. The information ratio is a ratio of portfolio returns above the returns of a benchmark to the volatility of those returns. The information ratio measures a portfolio manager's ability to generate excess returns relative to a benchmark, but also attempts to identify the consistency thereof. The ratio will identify if a manager has beaten the benchmark by a lot in a few months or a little every month. The higher the information ratio, the more consistent the manager is, and consistency is an ideal trait, as mentioned previously. Since common inception, the PSG Wealth Global Creative Feeder Fund has delivered superior 3-year rolling information ratios over all periods when using the CSA peer group average as the benchmark. We also use the Sortino ratio to analyze risk-adjusted returns. Since common inception, the PSG Wealth Global Creative Feeder Fund has delivered superior 3-year rolling Sortino ratios over all periods when using the South African CSA Global Equity General Sector as the benchmark. This means that per unit of risk assumed, as measured by downside deviation, the fund has delivered superior returns. Here we highlight why the PSG Wealth Global Creative Feeder Fund has a minimum investment horizon of 7 years. Over the short term, such as 1-year rolling returns, the fund may deliver negative returns due to its full allocation to equities and the inherent currency risk. The range of short-term 1-year returns are relatively large, ranging from -9% to 36%. The shorter-term returns may therefore be quite volatile. As the holding period increases, the lumpy short-term returns smooth out and the range of returns decreases. As you can see, the range of returns over 3 years is much smaller, as asset class returns tend to converge to their long-term real return averages over time. Over 7 years, the range should be even smaller. That's why this would be a more ideal holding period for equity funds. Moving on to the third pillar of our investment philosophy, fees. We aim to offer value for money for our clients. This graph illustrates the value for money principle for the Global Creative Feeder Fund. The TR, or total expense ratio, is represented by the solid gold line, while the fund's illustrator fee is the dashed line. The TR is the 3-year annualized historical fee paid by investors, while the illustrator fee gives an indication of what a current investor in the fund pays. We can estimate this figure as we have 0 performance fees in our fund of funds and its underlying funds, and have fixed negotiated management fees with our underlying managers. The illustrator fee is currently 1.27%, which is 0.24% lower than our CSA peer group average of 1.51%, and 0.35% lower than the global GIFS peer group average of 1.62%. The fund therefore offers great value for money for clients wishing to invest in an actively managed global equity fund. In conclusion, the PSG Wealth Global Creative Feeder Fund is an aggressive solution. It has a minimum recommended investment horizon of 7 years. It is for clients seeking long-term wealth creation that are comfortable with market fluctuations, in other words, short-term volatility. It is ideal for clients that wish to participate fully in global equity markets. As it is not Regulation 28 compliant, it cannot be used by itself in investment products that have to comply with Reg 28. However, it can be used in a combination with other funds in these products as long as the overall investment complies with Reg 28. It can be used as a standalone fund in discretionary investment products, such as unit trust investments and a tax-free savings account. That is all for today. Should you wish to obtain more information on any of our PSG Wealth funds, please feel free to contact your dedicated investment specialist. Thank you for your time and have a good day further.